Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near and intermediate term. For this week, it looked like coming off or heading into Thanksgiving week that the S&P was set to deliver the worst November since 2008's financial crisis. But conditions aligned for a rally that saw the S&P 500 close higher for the seventh month in a row. At one point, the S&P was down 5% off the late October peak that saw the index close below the 50-day moving average for the first time in 138 trading sessions. We also saw the VIX index close at the highest level since April. But heading into Thanksgiving week, the S&P 500 hit the most oversold level since the depths of the trade war sell-off when you look at things like the RSI, measuring price momentum. Several measures of stock market breadth, but we're also testing oversold levels. So you combine that with signs that bearish sentiment was becoming elevated, and you've also got this incoming period of favorable seasonality. Stocks found traction and surged to finish out the month in the S&P 500. Eked out a gain for the month. It's closed higher now for 7 consecutive months, as you can see in this chart. This looks at months in a row where the S&P has been positive, and you can see at 7 months in a row, this is the longest stretch since 2021. And looking back at least to 2009, 2010, this type of stretch does not happen often. But here's the thing. What I found more impressive is that the participation in the advance has also been strong. You're even starting to see several breadth thrusts that are close to triggering. So one that gets a lot of attention is this wig breadth thrust. And that means measures of the average stock are holding up really well. In some cases, making new highs ahead of the S&P 500. That's very bullish. Here's the other thing you need to pay attention to. Economic data is now slowly being released following the government shutdown. In my opinion, when you look last week, the most notable report was initial jobless claims, because they fell to 216,000 during the week ended November 22nd. That is the lowest level in 7 months. Claims also remain near the historic low end of the range. So evidence continues pointing to an economy and labor market that's holding up just fine. That is supportive for the earnings outlook. So I want to go a little bit more deeper this week into the surging breadth that we're seeing behind the S&P 500's rally, and why strong participation by the average stock that it is positive for forward returns. I also want to look at silver. So silver making a huge move to end the week last week, breaking out to record highs. And I want to look at some factors that could drive more gains in precious metals even further, including gold and silver. All right, so oversold conditions off the October peak helped spark the rally you saw into the end of November. That included several breadth metrics that neared the lowest level of the past few years. So what this chart on here shows, this shows in this middle panel here, the NYSE McClellan oscillator. That takes the difference between advancing stocks and declining stocks on the NYSE over a trailing period. You can see this hit the third most oversold level of the year, and now you're having the oscillator quickly rebounding to one of the highest levels of the year. That shows strong participation by the average stock in this advance, and that means you're seeing several breadth metrics close to triggering. If you just look at the table in this chart, this shows the performance of the S&P 500 when this oscillator has gone from minus 60, which is what we had, that minus 60 reading, to over 35 in just a 5-day span. When you look ahead, that tends to see strong forward returns, especially when you look 6 months and out. 6 months, 9 months, 1 year out sees much better than average returns with high positive rates, high win ratios. So participation in this rally that is sending the indexes tracking the average stock to new highs, and that is happening ahead of the cap-weighted indexes. So one way of tracking the average stock is through the cumulative advanced decline lines, and all these do is they take the difference between advancing and declining stocks, and it plots them as a line over time. So over time, so that's what this chart shows. This chart shows the cumulative sum of advancing versus declining stocks each day on the S&P 500. So it takes each day's reading, adds them to the prior tally to create this overall reading. And so here's the thing. While the S&P, along with several members of the Magnificent Seven, mind you, while several members of the Mag 7 and the S&P remain below the record highs, you can see the S&P 500's advanced decline line made a new high last week. So that shows really good breadth in the uptrend, and that is a bullish condition that I believe can help drive a rally into year end. At a time when breadth hit oversold conditions and bearish sentiment was becoming elevated, well, now you have the S&P 500 also entering a favorable period of seasonality. The period running from just before Thanksgiving here in the U.S. through the start of the new year is a historically strong stretch for the stock market. Now, the month of December is also known for delivering positive returns. Since 1950, this chart plots on here the average return by month since 1950 for the S&P 500, and it also shows a percent of the time that the index finishes that month with a gain. All right, so since 1950, the S&P 500 has averaged a 1.4% return during December, but where December really stands out is that it has a 73.3% win rate. That is the highest any month out of the year, again, using data going back to 1950. Now, I will note the S&P 500 did finish December of last year with a loss. It doesn't happen often. The last time the S&P 500 went for a back-to-back losses in December was during the 2014-2015 period. All right, let's talk about precious metals really quick. So precious metals, particularly silver, are seeing really strong breakout to finish out the week. Now, this silver chart, I highlighted this last week, the setup that we're developing. You have this, looks like a cup with handle pattern. But really what this is showing is that you have a series of smaller pullbacks in place. So silver topping out near this $55 per ounce level back in October, pulled back toward the 50-day moving average. That's this black line on here. Rallied back to resistance, smaller pullback, again to support the 50-day holding. You had the MACD make a bullish momentum reset above the zero line, and now you have silver breaking out of this bullish pattern. Here's why this is so significant. It is because these prior highs on silver, this was seen back in 2011 and in 1980. In those instances, when silver hit these levels, it had a sharp decline, a sharp pullback. And this time around, we've seen very constructive basing action leading to a breakout. And this breakout could just be in the early stages for silver, and we could see a lot more new record highs along the way. And that is because silver prices, when you look at silver, called the valuation ratio, is still favoring a move in silver. And so what the chart on here shows is the gold to silver ratio. So this is the ratio of gold to silver. A rising line means that gold is outperforming silver. When the line is falling, that means silver is outperforming gold. Now, gold was really the first to break out to new highs. So this really started happening with gold prices back at the end of 2023, start of 2024. And as gold surged to new highs, its rally was outpacing very easily what you saw with silver. So you have this rising line on here. But this took the ratio back toward some of the highest levels that you tend to see historically. And now, mind you, this chart goes back to the 1970s. So you can see this ratio being hit in the early 90s, and again during in the aftermath of the pandemic in 2020, and coming back to hit that ratio earlier this year. Now we're seeing mean reversion the other way. That means silver is outperforming gold, but you can see even though this ratio has come in, it is still well above average historically. So that means we could still see more mean reversion on silver's breakout in terms of silver momentum outpacing gold. So one other factor that could boost precious metals, including both gold and silver, is if we see a return of bearish action in the US dollar index. So at one point this year, the dollar was off to a historically weak start. So we know there's concerns over currency debasement with deficit levels and rising debt relative to GDP. But the other thing is that commodities are priced and traded in US dollars. So when you have The dollar index, this is what the dollar index does is look at the dollar against a basket of other currencies like the euro, the yen, the pound, so on. This fell into mid-year, and it had a historically weak start to the year again through about the midpoint of the year. But you can see the dollar index has stabilized since then. So rallied and has just been kind of range bound since the middle of the year, but now we have another potentially bearish pattern to watch. So as the dollar index is testing the 200-day moving average, so chopping around this 200-day moving average, that's the green line on here. The RSI in the bottom panel is making a lower high as the dollar index goes back to the 100 level. So you can see the dollar index rising to the 100 level. That coincides with the 200-day pullback, another rally, took it above. Now we've been chopping around, but this is the 100 level again. On that test of the 100 level, the RSI down here, you can see making a lower high. So that is a bearish momentum divergence. And if we see this spark another downside move in the dollar index, that could become another tailwind for precious metals, just like we saw during the first half of the year. All right, a lot of economic data to keep an eye on this week. Reports coming from both government agencies, which we have the government shutdown ending, government reopening. So we're starting to get more government sponsored economic data coming out. We also have data coming from private sector reports. So the two I'd really pay attention to this week is these reports on the ISM manufacturing and non-manufacturing. This is a services PMI. These things are a real-time look at what's happening in the manufacturing and service sector of the economy. Look at the underlying components of these things. They're constructed so that a reading above 50 indicates expansion, below 50 is contraction. Look at the thing that's going to really receive a lot of attention in these two reports is what's happening with new orders, which is a leading indicator of activity. So we want to see new orders above 50, but also where prices paid is coming in at. So prices paid is a leading indicator of inflation. It's been running really hot recently, especially in the services measure. Now, the other thing I would keep an eye on is if we get this PCE index for the month of September. Now, again, we're talking about September. We're now entering December, but, keep an eye on developments on the inflation front as it pertains to the Fed meeting, final Fed meeting of the year coming up. And by the way, we do have Fed Chair Powell speaking. So this is a chance for Powell to really broadcast his view potentially, if he chooses to do so, on what the Fed is going to do at its final meeting of the year. One trade idea to keep an eye on this week is with Tesla. Tesla continues to create and trade in a constructive basing action, and this is happening right at the prior all-time highs. That makes us very, very significant. So Tesla peaking out near the 490 area back at the end of 2024, pullback as the rest of the market was in decline into the trade war. Now it's rallied back toward the prior highs, again around that 490 area, and came back, tested it a couple times. Overall, relative to this pullback, we're now seeing a smaller pullback in place. And so, these series of smaller pullbacks is what you like to see. It shows there's demand for shares. It shows accumulation. And I really think, what I would like to see is one more rally toward this resistance level and probably just a smaller pullback before setting the stage for a breakout to new all-time highs. I believe that, in December and potentially heading into next year, that when you look across the Mag 7 stops, that Tesla can be a leader on this rally. All right, that's all for this